Are you the type of person that sees this glass as half full or as half empty? Well, as we sit here in 2022, it might be difficult to see glass as being half full right now. After all, from a surface level, most retirements have gotten certifiably worse this year with financial losses. That being said, here at Safeguard, we're big proponents that during every market cycle, there is an opportunity to move your retirement forward. And in this video today, I'm going to talk about a specific opportunity available to you right now in 2022 to eliminate an annual tax problem I see so many retirees face. Let me show you what I mean. Now, in today's video, we're going to be focusing on taxable accounts, otherwise known as non-qualified accounts. And the reason we're focusing on this account is because this is where a ton of tax problems are generated from. And the reason being is because any income or gains that you generate and then realize in any given year are passed through to you as an investor, and you have to pay taxes on an ongoing basis. Now, we have 5 taxable accounts on the screen right now to show you how to make this type of account more tax efficient. And the first one is what we're going to be focusing on in today's video. Don't hold mutual funds in your taxable account. Now, the main tax problem from mutual funds is capital gain distributions that it pushes through and forces investors to take. Now, remember, anytime we have forced income in retirement, we want to avoid that. We want to choose when to take taxable income so it best fits into our situation. Now, you might be thinking here as a mutual fund investor, because the market is down this year, that there shouldn't be any capital gain distributions. After all, I haven't gained anything within my mutual fund. And this would be a mistake in making this assumption. The reason being is because capital gain distributions are something that happens each and every year. In fact, typically when we see a substantial market downturn, on average, mutual fund distributions have actually been higher. And there's 2 big reasons that mutual funds have these large capital gain distributions on an ongoing basis. The first reason is allocation turnover. Let's say a mutual fund sells a portion of investment ABC and rebalances that back into investment XYZ. Well, that then generates a tax distribution and is passed through to investors. Well, we know that most rebalancing back to a target allocation happens during steep market declines as well as steep market increases. And so because of this, again, we tend to see the largest distributions during down markets. The other key variable for why mutual funds have large capital gain distributions in down markets is investors leaving the funds. And we see that this is most prevalent during these down markets. When investors leave funds, mutual fund managers have to sell assets in order to get the cash to that given investor. And these capital gain distributions, like any distribution of income from these taxable accounts, ends up being a tax drag. The reason being is because you now have to take that income, you have to pay taxes on it, and now invest less. And so there's less compounding for you in the future. And you can see this on the screen. Now, the chart you'll see on the screen is looking at dividend rates. But when we talk about capital gain distributions, for the most part, these will have the same tax consequences, the same tax drag. And so if we look at not having any capital gain distributions or dividends versus having an annual 3% or even 5% capital gain distribution, you can see how much value leaves your taxable account. If we look at the growth of $100,000 growing at 10% per year for 20 years, and we look at the various differences in tax drag rates, we can see that no tax drag ends up with that $100,000 growing to over $670,000. In the worst scenario that I'm showing here with a 5% dividend or capital gain distribution rate, we see that this gives up about 12% of the after-tax value within this account. Now, this is looking at something called step up in basis value, meaning your taxable account would be more of an estate planning tool. If this is going to be something you liquidate for your own retirement, we would see these values shift a little bit. Now, many of you that consistently watch our Safeguard Wealth Management YouTube channel are very aware of this tax drag. But maybe because of holding mutual funds for a long enough time, you have large enough unrealized gains that it hasn't made sense to exit that mutual fund and build a more tax efficient investing strategy. Well, this is exactly where this year's opportunity comes in. Let's take an example where you own ABC Mutual Fund and it has a 30% unrealized gain at the beginning of this year. So maybe you haven't seen the benefit thus far of realizing that 30% gain, taking that tax drag this year in order to improve that moving forward in the future. It just hasn't made sense. Well, this year, because of market declines, it now might make sense. And it might be the perfect opportunity to now exit this investment and build that more tax efficient investing strategy. For instance, let's say that ABC Mutual Fund is down 20%. Well, that unrealized gain now has transformed from plus 30% after this decline to only being a 4% unrealized gain. Now it can make sense to then sell that investment. Yes, you're still taking a slight tax drag by realizing that 4% gain, but now investing that in an ETF equivalent that'll be much more tax efficient. And the reason this can make sense is because depending on the capital gain distribution you're expecting this year, taking this tax drag might be more beneficial than taking the capital gain distribution later in the year. For instance, let's say the expected 2022 capital gain distribution for this ABC mutual fund is expected to be anywhere from 3 to 5%. Well, then you're already going to have a 3 to 5% distribution tax drag. So why not be proactive, exit this mutual fund ahead of the capital gain distribution, and then enter into a more tax efficient strategy. This is exactly why the glass is half full for so many investors. Yes, you might still have a very large unrealized gain. You might have next to no unrealized gain. You might even have an unrealized loss within these accounts. But this opportunity has only presented itself because of the market decline. And so this is an exact situation where you can make a change during this market decline, take advantage of this decline, and step your retirement forward as we move into the future and we see a recovery in financial markets. Now, how can you go about estimating what your 2022 capital gain distribution is going to be from these various mutual funds? The nice part here is most mutual funds release estimates ahead of time for what their end of year capital gain distribution will be. And finding these estimations is pretty straightforward. So you're going to want to go to Google and let's look at JP Morgan mutual funds, for instance. You're going to want to type into Google 2022 capital gain distribution estimates for JP Morgan. Click enter, and what you're going to find typically is a PDF and one of those early search results. Click on that, and you're going to see a breakdown of all of the mutual funds that JP Morgan releases. And all you want to do is find the mutual fund that you're invested in, find the record X and paid date. These are going to be the dates where they start to release those given capital gain distributions and when you need to exit the fund by. And then you can also see the estimated percent of NAV, so the percent of the investment you have within that account that they're going to release as capital gain distributions. You can see short-term and long-term. Now, some of these, like the equity index fund here, is going to have a very small capital gain estimation at the end of the year. Other funds, however, like the mid-cap value fund that we see here, has quite large capital gain distributions. 21 cents of short-term capital gains, $3.06 of long-term capital gains, for a total capital gain distribution estimate of 9.5%. Now you can look at this estimation for any mutual fund that you have, and this will help you make better strategic decisions. So for instance, if my unrealized gain right now is less than the distribution that I'm going to have at the end of the year, to me it's a pretty no-brainer decision to exit that right now and avoid that distribution. Now, before you go ahead and utilize this opportunity here in 2022, I want you to think about 4 things, okay? The first is tax, fee, and performance drag of your current investment versus the new investment. For instance, if these drags are very high, you may want to be more aggressive, and regardless of the other variables, it might make sense to exit this investment for a more tax efficient or just efficient investment in general. If these drags are small, however, you may need to look at some other variables here. The second thing to consider is your current tax year situation. For instance, those that are earlier in retirement, it may make more sense to be aggressive now rather than those that are a little bit later in retirement. The reason being is if you're later in retirement, you have a lot more hurdles to worry about. Things like the Social Security tax torpedo, IRMA, various other hurdles that we talk about a lot in our videos. Earlier in retirement, however, you can likely perform large Roth conversions and still realize some of those gains. The reason being is because those long-term capital gains will stack on last and may not really change your overall marginal tax bracket for those capital gains. Number 3, do you have other losses you can use to offset either this year or through a carry forward? So if you've already done a lot of tax loss harvesting this year, you may be able to exit mutual funds without really even seeing any unrealized gain that you now have to realize. And this is a perfect situation. You're able to take the losses you already have, exit less tax efficient investments, and now invest all of your money more tax efficiently moving forward into the future. And then finally, what do your future tax year estimations look like? If you have some big tax hurdles coming down the road, again, you may want to be more aggressive now than in the future. However, regardless of the decision that you make this year, understanding how to make your taxable account more tax efficient is paramount to getting the most out of your retirement plan. You can click on this video right here to learn more about our 5 taxable account rules. Always remember that you don't need more money, you need a better plan, and you need to be a half full investor.